All right, thank you very much. Hi guys, hi everyone. My name is Fabian Leimer. I'm the head of partnerships at Blockbit. So I'm basically dealing with exchanges, brokers, providers, and trying to navigate the complexity of taxes and making it simpler for everyone. And today I'm going to give you a talk about what is the EU Crypto Reporting Initiative. So basically what is the DAC8 and what you can do to prepare for what is coming. All right, that's exactly what you warned me about. Before we go into more detail into what is CARF and what is the DAC8, I wanted to give a quick rundown of what is the actual tax law in Germany, because the DAC8 is a complete perspective on the whole tax system, not only EU-wide, but on a worldwide level. So we first need to understand the tax laws for each respective country and what is actually allowed and what not in order to work smart. And this is why I prepared this little slide for you. I assume most of the people are actually aware of what are the basic rules in Germany, which is the withholding, the 1 year holding period, right? So if you sell your assets within the 1 year, you will have to pay full taxes on that. And that depends on what you're actually having if you're selling a crypto or a derivative, because those are then two different tax types as well. And then also swapping is considered a taxable event in Germany, as well as receiving staking rewards, mining rewards, any sort of interest which you accumulate through your DeFi products or whatsoever. And also, mostly forgotten, income. If you're getting paid in crypto, obviously you will have to tax that as well. This was now a little bit of the bad side, I would like to say. However, I think personally that the German system is also very neat, especially because of the tax-free aspects you guys are having, which is obviously buying crypto is considered tax-free, but the most or the biggest asset you're having is selling and swapping after 1 year is also a tax-free event. So what you could do is just buy some Bitcoin, hold it for a year, sell it after, no taxes whatsoever. Me personally, I come from Austria. I can swap crypto to crypto and don't have to pay taxes on this. But I don't have a 1 year holding period. So it doesn't matter if I swap between assets or have an asset for 5 years or 10 years. I always have to pay taxes when I cash out of the whole crypto system. This is why I personally think that the German crypto framework can be quite nice. Let me frame it that way. Also tax-free are airdrops, gifts, and obviously if you want to stake something, delegate something, or put your asset as a collateral. Yeah, as I said before, there are different tax brackets, and depending on what you do, you fall into a different tax bracket. So everything, I would say, crypto-related, so staking, lending, mining, buying, selling, swapping, everything that is considered crypto income and is taxed with the Einkommensteuer, so the classical capital gains tax. And everything which goes more towards options, derivatives, futures, this falls under the derivative tax, which is a different tax bracket. Why is this important? There are actually two reasons. One is there was a new, in German, BMF Schreiben, so it's more or less a guidance of the BMF, of the regulator, in the beginning of the year, so in March, which highlighted a couple of things and also made a couple of things more clear related to this whole tax framework. So first of all, the order of acquisition, in German Verbrauchsreihenfolge, was fixed to be FIFO principle. And FIFO stands for first in, first out. So the asset you're transferring at the wallet first is also the asset if you transfer from this wallet to somewhere else, is also the asset you take, even though there might be more batches on there. I'll go into more detail later on. The second is the valuation, so basically the cost method is also to be used as FIFO, and in some cases it can be considered as average cost basis, but this should only be done in consultation with a tax advisor because it is still very, FIFO is the one which is seen by the regulator, but there are some exceptions where you can also do average cost basis, but yet again, like you need some proper documentation on it and some proper argumentation of why you think you can use a different valuation method. The consumption order and the valuation are also based on a per wallet basis. So in German, Depottrennung. So that basically means you're having different wallets, and for each of those wallets you have those rules applying. So you can't mix those wallets. If you have an asset on one wallet, then the holding period starts there. If you transfer it to another wallet, then a new holding period starts there. And then lastly, and this is the most important point from the regulator, the obligation of the record keeping, documentation, and all of the tax filing was shifted to the user. It was already clear that the user is actually required to share this information, but now it was even made clearer that it is your responsibility. And if you don't do this, it's your fault and not the regulator's fault, at least from the perspective of the regulator. So, what is the crypto asset reporting framework? Basically, it's a communication framework between 48 countries. And those countries include all major ones in Europe, but then also across the world. As you can see, USA, Canada, Mexico, Brazil, South Africa, Singapore, Japan, Korea. And this is where it gets interesting, it also counts those, I would say, nice to get a license countries. Isle of Man, Cayman Islands, Lithuania, Estonia, Cyprus, Malta. So countries, exchanges chose on purpose because it was a little bit easier to get the license there. And what is happening as of the 1st January 26, so in like a couple of months, is that this crypto asset reporting framework is kicking in, and it basically means that if you as a citizen of one of those 48 countries trade with any exchange which have a license in any of those 48 countries, all of the information, all of the trading information is going to be shared with the country's regulator. Quick example, Binance doesn't have a license in Germany. So hypothetically speaking, if I'm trading now at Binance, Binance is not obligated to share any sort of trading data with the regulator, except the regulator like literally asks for it. And until now, they still have to like kind of sue them to get this data out. This is going to be changing completely with this crypto asset reporting framework. Because when this kicks in, and you're trading at Binance, and Binance has, let's say, a license in France or in like Isle of Man, doesn't really matter, like any of those 48 countries, they are obligated to share all of their like German user data with the German regulator. Very important, this counts as of 1st of January, so there is not the possibility for them to go like back 10 years. But what we see happening already is that if they get the data, they analyze the data, and then they see, for example, all right, we have a lot of data here, and we don't really think that like the trading volume and the taxes add up for those kind of people, or like for a couple of people. Then what they're doing is, then they're like suing the exchange to get the data. It's like a Auskunftsersuchung in German, where they go to the exchange and say, hey, please, you have to like open this data to us. And this, unfortunately, goes also back 10 years. So even though you might not be affected by CARF, you can still be affected later on by this suing of the regulator for the exchanges. As I said, this is kicking in 26. However, the first reporting season is then 26, so it will be reported like 27. You know, like tax reporting is always like 1 year back. So the 2026 is the starting date of data collection. And then this data is getting shared, and then in 2027 is actually the first time the regulator has the data and can like work with the data and can then do whatever they want to do with it. Probably writing a lot of emails and requesting a lot of additional information from you, because you are the one obligated for the reporting and for the documentation, as I explained before. And even though the crypto asset reporting framework, so the CARF, is only situated to cryptos, obviously this like Auskunftsersuchen, so like when the regulator is suing the exchange, is not only to crypto, but for the complete trading history. So they don't care if you did derivatives trading, if you did crypto trading, if you had like any sort of other digital assets, they want to get everything. So it's important to have a complete transaction history. This means including from literally the first touch point of crypto, let's say a bank, right? You go to a bank, you get some money, you transfer the money to a broker. At the broker, you buy some Bitcoin or Solana, you send it to like a hardware wallet or like to a software wallet, you do some DeFi stuff about it. They want to know everything. So it is up to you to have this information ready and documented. There are various different types of digital assets, right? We have commodities, we have currencies, we have token, we have NFTs, we have tokenized securities. And under MiCA, there were still some exceptions. For example, NFTs is still like considered a little bit of a gray zone where you can argue, okay, I don't have to pay taxes on NFTs. It's like still a little bit of a common practice in the industry yet. But under CARF, as you can see, like it includes everything. It includes all asset types across everything, yes. So having heard all of this, first of all, sounds incredibly frustrating. And secondly, so it's incredibly frustrating, and secondly, but also gives you chances to work with that regulation in a way that you actually profit from that. So it can be, in a way, also be good for you. And what I want to do today is give you 3 practical examples you can basically do right now to save on your taxes. Doesn't help you save on the data sharing point. This will happen no matter what. The only possibility you're having there, before I go into that, is deleting your crypto exchange accounts before 1st of January. If you don't want to stand on the list, basically, which is then transported to the regulator, you need to deactivate your account before the 1st of January. Yet again, it can still happen that later on you might get an inquiry to provide more data, but at least at the initial data set, you won't be included. I personally need like 20 or 30 exchanges to like test, and I'm a I'm a partnership manager, so I need to look at all of those exchanges. Obviously, I need to KYC for all of those exchanges, so I will try to delete 15 exchange accounts. Because I don't want to be on the lists anymore, right? This is what my plan is for the time being. But let's see, it's gonna be interesting for all of us. Despite the data part, there is still some legal possibilities on how you can actually like save some taxes, and I want to present 3 of you today. One is the separate holdings, which is like very easy. You just send your tax-free Bitcoins to a different wallet because you have the first in, first out principle. So if you bought like various Bitcoin through batches, you DCA, dollar cost average, into Bitcoin over a period of a year. So you have like several batches. The first batch you bought is actually the one which is tax-free after a year. And it will also be the first batch you move first in, first out. So if you want to sell, for example, some of your assets which are not tax-free yet, and you want to hold your tax-free assets, you need to first transfer those tax-free assets away to a different wallet. You can think about it like a glass of water, right? You have this here, and you batch it up. So the first batch is going to be at the bottom, and the last batch you bought is going to be at the top. But you need to get the last batch out first, because it is the tax-free one. And that's basically separate holdings, Depottrennung, Bestandtrennung in German. I would say very, very easy and very simple technique. Everyone can use it right away. There are also tools you can check whether or not or how long you still have to hold certain assets to know when this 1 year holding period is over. Second method you can do is loss offsetting. This means you deliberately use the various tax categories we looked at before and offset them within the same category. This means if you're trading a lot of crypto, it makes a lot of sense for you to buy more crypto, because then you can offset the good trade you made versus the bad trade. Until to a certain point, of course. If you trade a lot of shares, it might make more sense, or derivatives or options, it might make more sense for you to open a 1x leverage position on Bitcoin, because from a tax perspective, you wouldn't have Bitcoin, but you would have a derivative position, which you can then use and offset against your other derivative positions or like other option positions you made. So you can actually consciously use those different tax brackets to like save on your money and like use it to your advantage. If you know you're doing a lot of crypto and, for example, you made a lot of losses in crypto, okay, great, then it might make more sense to get a good crypto trade and try to diminish that. But yet again, it's totally up to you, totally up to your strategy. It just gives you more flexibility of what you want to do. And the last one works really well, especially in Austria, is avoiding regulation through loans. As I said before, a crypto loan and a collateral is not considered a taxable event. This means you have half a Bitcoin, you give your half a Bitcoin to a platform where you get like 80% value from the half a Bitcoin in cash, like Nexo or like any other of those providers. The money you're receiving is completely tax-free. You can cash it out, you can do whatever the frick you want with it. And the only thing you need to take care of is not trying to get liquidated your initial collateral position. Like if that happens, then it's really bad, because then it's like twice. Like you made two mistakes basically, right? Because you have a realization of your asset because your asset got sold even though you didn't want to, so you would have to pay taxes on the profit you made on the Bitcoin you put as a collateral. And also you still need to pay back the loan because your position got liquidated. So there is risk involved, especially with the last strategy. But if you need, in Germany, if you need like quick money throughout the year, this like getting a loan and cashing out the loan is a very good possibility. In Austria, where I can literally only have to pay taxes when I go out of the crypto system, this makes even more sense. Because even like I have like really old Bitcoin, I can just send them there and just get the money out and have that with me. All right, so there are various ways of possibilities. You can use this to your advantage, but you still need to document all of this. And this is where Blockbit comes in. We are a tool which allows you to integrate all of your crypto holdings and also derivatives and commodities and fiat. So basically you can track everything despite actual shares and ETFs, and so certificates also. And yeah, you integrate all of your holdings with like various wallet addresses. Right here I have like some hardware wallet, I have directly some exchanges, Bitwavo, I have some software wallets, right? I put everything in there, everything what you're having, all of the crypto activities you did, you just connect everything. And what happens is that we load all of those single transactions you made and we already pre-labeled them with the tax relevant class. So we have, as you can see here, we have like airdrops, we have a trade, and of course there are also some unlabeled transactions. For example, if there was a euro sent from, like in this case, Bitpanda to somewhere else, obviously we don't know what that was, because you have to declare like what did you do that? Did you give that to someone? Did you, I don't know, did you cash out? Like, what you have to declare what you did there. And the goal is to get, I'd say like a 90 to 100% for this bar on the top right there. Then you know you optimized your taxes in a way that you're actually paying the least amount. If you don't do this, you are still compliant, but there might be some cases where we are not sure and we just take the most compliant way, which is always the worst way for you, because you're always paying the most. But it's the most compliant way, right? You can choose. There are also, it's also the possibility, obviously, to filter between those, getting those tips, right? And then you already see, for example, this is just some stuff I received, probably some airdrop I got, and then I can just note it as a spam, and then it will be gone. And so you basically click through all of those different cases you're having open, like pre-label them. This as well looks like, doesn't look good to me, so I'll just like shove it away, put it into a scam filter, and then it will not be applicable for taxes anymore. The end result will be something like this. It's an aggregation of all of your activities put together into the tax relevant paragraph. So under, for example, paragraph 23, as you can see, it's relevant that you did a trade and a transfer here, and then you have the cost basis here, and you have the proceeds. So we already see that I made a gain, and on that gain, on the 1.3, I have to pay some taxes. Same is for the transfer. Made some transfer within a year probably. Had a cost basis here. Made some gains. Great. So I have to pay taxes on the 175. And we do this for like all of your trades, and we accumulate everything, and then you just get this one report which you just file with the regulator, and that's it. So it's like it's made simple. You get the number out, and you literally input the number either in the field if you do like an online filing, or we even give you the forms if you do a paper filing. We give you the forms with you, so you just need to hand in all of the rest. This is only one part of it. Another part is, and that's like actually one of my favorite features, is the tax optimization, where you can simulate certain trades and the effect it has on your taxes. So whether or not it would be smart of you to sell, for example, asset X. Because you have certain free, like you have an amount you can use for free. I think in Germany, as of this year, like last year, it's already 1,000 euros, which is like tax-free. So you try to get those 1,000 euros at least. So if you didn't sell anything and you already made some profits, you can at least sell an asset so you get the 1,000 euros for free, and you can simulate all of those trades. You can see if I made a lot of losses, okay, maybe it would make sense to sell like this position because I made a loss there, and then I can offset it with the position I made a lot of gains there. So it really helps you to, I would say, become a better trader and become more aware of where you want to go. And this also helps you then later on because what you're documenting, and with the full documentation you have done in process, you can just hand it in to the regulator, say thank you very much, and even do simulations beforehand so you know what will actually happen. That's it from my side. If you have any questions, I'll be here. Yes.